Hello and welcome to Thank God It's Friday. Joining us once again is Saurabh Mukherjea. He's the Chief Executive Officer at Ambit Capital. And once again, we are going to take stock of what's going on in the markets. Thanks for joining us, Saurabh.
My pleasure. Thanks for inviting me.
Well, so Saurabh, the last time we spoke was back in September. The world has changed since then.
Absolutely.
We've had Donald Trump become the President of the United States. We've had demonetization come and play out. If I understand correctly, the target for the Sensex that you're putting for March 2018 as around 31,000. Which means that the well-other companies were expected to remain largely range-bound. Can you explain why?
So look, we've been very skeptical about the growth prospects for the Indian economy for a while now, for a good couple of years. It appeared just after the monsoon, in fact around the time we spoke, it appeared that we might be at the beginning of an economic recovery, but I think demonetization has put paid to that, and our view remains that it's not just a one-off event, that there's a consistent weakness in the SME sector. I don't think the black money crackdown is over. I think there's plenty more to come from the government in terms of the black money crackdown. I worry about the future of the 2,000 rupee note in India, and there's obviously GST coming, which will be a major disruptive event for small businesses in our country. So the economy is weak. Earnings growth has been disappointing for 4 years. I think the year to March 18 will also be disappointing for earnings growth. Every year consensus begins with these sort of fantastic estimates of 20% EPS growth, and by the end of the year we barely get to high single digits. I think it will be a repeat of the same. So much of the exuberance in the Indian stock market, I think, is misplaced, and I think the economy is in soft shape. To add to our problems, the RBI is clearly saying that they are done with cutting interest rates, with the Fed also hiking now multiple times and the Fed promising several more hikes. I think the monetary policy easing cycle is behind us. So you have a situation where fiscal policy is tightening India. The government has put forward a very hawkish fiscal policy tightening plan. The government is saying 25% growth in income tax collections are budgeted for the year to March 18. Your fiscal is tightening, your monetary is tightening, your economy is weakening. Stock markets are already feeling very exuberant. I think it's wise to be skeptical at this stage about a further strong rally in the market.
Okay.
So do you think there could be a risk in that view that the markets will give a near zero return in FY18, given that globally India still remains one of the very few markets with a strong earnings growth potential, and hence interest in Indian equities is bound to remain high, and that to some extent could justify the expanded multiples?
So look, there's always a risk that when you think markets will stay range bound or go down and they go up, but it's the nature of life. My reckoning is that earnings growth has been weak for 4 years, as I said, and I don't see any reason why suddenly this year earnings growth will take off. There's no recovery in the capex cycle in sight. The consumer economy is in reasonably good shape, but that's reflected in elevated PE multiples, elevated valuation multiples of most consumer stocks. If you ask me, the joker in the pack potentially is the metals and mining sector. Roughly a third of our Nifty stocks are plays on global commodities, whether it's oil, whether it's metals and mining, and that third, which is a play on global commodities, those stocks tend to have a 70 to 80% correlation with global commodity prices. Now that's one element that I don't think we in India have any control over. If commodity prices rally on the LME, on the NYMEX, then that third of the Indian stock market, which is reliant on commodities, will have a very good time. That's the only positive surprise that I can see, which can lead to earnings growth being double digit in the year ahead, rather than the 8, 9, 10%, which unfortunately has become the norm in India. Leaving that aside, and I'm no great commodity expert to opine on will we see a commodities rally, will we not. Leaving that aside, difficult to see how at the index level you make a lot of money from investing in the index at this stage. But as I said, we've been skeptical on the index for a long time now, and in that time it's gone down from 30,000 all the way to 22, and it's risen back from 22 back to 30. So my skepticism has been accompanied by the market being skeptical and the market being optimistic. If you leave the index aside and focus on stock picking, yes, there are a few stock picking options left, but increasingly even on the stock picking front, we're finding it increasingly hard to find buys in India. So I reiterate my point that you're seeing a weak economy, weak earnings growth prospects, genuine underlying pain in the economy, and inflated valuation multiples, and a general sense of exuberance in the stock market, which I think is a bit disconnected from the ground realities of the outlook, say from your studio of, say, the lower Parel area even.
Okay. So you're saying that clearly the Q4 numbers are going to be disappointing for the markets, and that the impact of demonetization has not really played out and will show over the long term. This is something that the markets are not considering.
It's not just the Q4 numbers. I'm saying even for the year ahead, the FY18. I think there's the weakness in the economy will continue to drag down numbers. And I'm not making. It's not as if we've had strong earnings in any of the last 4 years. So I'm not saying suddenly things will get worse. The economy has been weak for 3 or 4 years. Earnings have been weak. I think that will continue to be the case. What's happened is somehow people have convinced themselves that there's a recovery around the corner, and the stock market has rallied in anticipation. That hope of an imminent recovery, I'm saying, is somewhat unfounded by the ground realities in our country.
Right. Okay, so I'm going to come down to the information technology sector. We saw Infosys earnings. I don't think there was too much with respect to expectations with Infosys, and this is going to be the same for the rest of the IT companies. However, there is also this hope that the larger IT companies will eventually change their business models going forward. Valuations are relatively cheaper. What is your position on the information technology sector?
So look, I'm not allowed to comment on any stocks, but I do think this is one sector where what exactly Trump does to India is something which is hard for us to gauge, right? And I think the share prices factor in the Trump uncertainty of his H-1B policy actions. Already there's been a fair bit that he's said, a little bit that he's done. He's talked a lot more than he's actually done, and the stock prices have moderated on the back of that. My reading would be that a whole bunch of smaller Indian IT players will find the going very tough in the years ahead. One or two scale gorillas who clearly have a cost advantage, a pronounced cost advantage on their side, will continue getting business from Fortune 500 companies, the FTSE 100 companies, but I think it will be as small as that. We'll have a couple of large Indian IT companies who will have a good run over the next 5 to 10 years in terms of getting business from Western companies, especially low-cost outsourcing business. Beyond that, I think Indian IT services does face a serious question mark. The levels of innovation in Indian IT services have been weak for a long time, and I think that inability of our sector, of our IT services sector, to innovate finally is catching up with them. It just so happens Trump's intervention is crystallizing that lack of innovation and creating serious question marks on the viability of several Indian IT services models. But a couple of the largest IT companies, I think, have a genuine chance using their scale to become scale gorillas, low-cost players in the global outsourcing market, and I think that's where the investor attention should go. For those couple of large companies, I think valuation multiples have become very reasonable because Trump's banged the sector down. Valuation multiples for those large IT companies have become very, very attractive, and these are cash generative companies with high dividend payout policies.
All right, shifting the focus to banks, they have run up sharply. More so, the public sector banks have run up sharply in the recent past. In fact, 20% year to date. And that's probably on the hopes of NPA resolution to some extent. But even in the past, there has always been a lot of talk of bad loan resolution, and whenever the measures have come, there hasn't been much success that has come out of it. Do you think this time also we might end up with a similar situation, and probably the markets are not really pricing in these failures and the fact that these tough times for banks are here to stay for a long time?
I think there's a two-pronged problem with our public sector banks. One is, as you were rightly saying, there's a consistent inability on the government's part to bell the cat. Bell the cat in the sense, somebody has to take more like a $30 billion hit. So the government has to pay the bill, a $30 billion bill, which is roughly 1.5% of Indian GDP. and both from a fiscal perspective, if the government spends $30 billion on bailing out banks, that's $30 billion less on other activities. That's a tricky political call, and I don't think anybody has had the courage to make that call in the first 3 years of this government's life. It's difficult to blame this government because it's not as if any other government will find it easy in a country like India to say, I'll spend 1.5% on GDP on bailing out banks who have lost their shirts on power, infrastructure, telecom, lending, etc. So I think that's problem one. But the most structural problem with PSU banks is that every decade they get ravaged by this problem, where they lend money which never comes back, and then the taxpayer has to bail them out. Given these twin problems, political reluctance to put their hands in the pocket and dig out $30 billion, and B, a serious concern on can these banks actually ever lend money wisely on a decadal basis. I really find it hard to understand why these banks some of them trade at premiums to book value. You really have to be a huge optimist to believe that PSU banks above book value, and to buy a PSU bank at above book value and expect to make money, you'll have to have serious market timing skills and a massive dose of optimism that miracle will transpire, where A, the government of India will dig deep into its pocket, and B, the banks will find a new lending model which doesn't compromise their finances every decade. Unfortunately, that sort of optimism, I find it hard to sort of drum it into myself.
So, continuing with financials only, what are your thoughts on NBFCs then, especially in the backdrop of these farm loan waivers, which are likely to add to the possibility of this stress and hurting the credit discipline of borrowers? Is there any sub-theme within the pack that you still like?
So I'll tell you what, I think where the BFSI opportunity in India in the next decade is not going to be in lending, it's going to be in saving. Right? Historically, we've saved around $300 billion in financial savings as a country, but till 3 years ago, we used to do around $400 billion a year in physical savings, gold and real estate, right? As we know, we've stopped saving, largely stopped saving through gold and real estate, and that money, that 400 that we used to put in physical, a lot of that, I would say 3/4 of that 400 that used to go in physical savings, 3/4 is swinging to the financial system. So financial savings are exploding, right? Which is why one of the reasons why the stock market is running up and the bond market is running up is financial savings are exploding. I reckon by 2020 we will save $1 trillion a year through financial savings, right? At the moment we barely do $500 million. We will, in the next 4-5 years, financial savings will double in India. So the big BFSI opportunity is not in lending, it's in savings products. Mutual funds, general insurance, life insurance, wealth management, broking, that's where the massive opportunity is. Unfortunately, there aren't too many listed plays on savings. There are 2 or 3, and I would urge your viewers to take a look at listed plays on savings, not lending. In a country where capital is scarce, being a lender is a very good idea, because you've got real power, people are begging you for money, and you set the terms, you have punchy NIMs, punchy ROEs. But in a country where capital is becoming cheaper, savings are abundant, capital is cheaper, you want to be a provider of savings products, not lending products, right? I think for NBFCs, the problem gets compounded further, because by definition almost, NBFCs lend to that part of the economy which the banks don't want to lend to, right? And being more specific, NBFCs lend to SMEs whose cash flows are, to put it politely, a little irregular, perhaps a little black. As the Prime Minister continues his squeeze of the black money ecosystem, whether through demonetization, through the Wages Act, which was passed on 8th February, through GST, which is imminent, through these 2 million income tax notices that have gone out, that SME sector, I can almost visibly see the SME sector is wilting in front of our eyes. The NBFCs will be natural casualties of the crush in the SME sector, of the consolidation of the SME sector. The large listed entities, whether it's in FMCG, in footwear, in electricals, in building materials, the large listed entities will be the big beneficiaries, but a whole slug of our economy, roughly 40% of GDP, will get crushed as we formalize the Indian economy and kill the black economy. The NBFCs are the guys who are in the way of that steamroller. They have financed a big part of the of the informal economy. So my reckoning is that the big opportunity in our country in financial services the next 10 years is not on the lending side, it's on the savings side. Unfortunately, there's no more than 3 or 4 listed plays on that, which in turn highlights the extent of the savings opportunity.
All right. A lot of attention is going to eventually divert to monsoon sensitive stocks, and I want to address the crop protection companies in this case. While there is so much attention given to monsoons, there isn't enough spoken about the farmer's ability to buy crop protection in that specific year, whether or not there are deficient monsoons, and the other one is the launch of products by the companies. How are you reading this sector? Now I do know that you do have you have view on PI Industries and Rallis, and I understand if you don't want to give your views on those. But how are you viewing the sector and how are you viewing the opportunities in this particular space?
I think there's 2 different things to consider. One is, will we have weak monsoons and what effect does it have on lending stocks and FMCG, on two-wheelers, etc. I don't think I've got any great science to add to that. I'm neither a weather forecaster nor do I have anything fresh to add to the debate. We broadly tend to know which lenders, which two-wheeler companies, which FMCG companies have monsoon sensitivity, and I think it will be the same list again. If the monsoons fail, it'll be the same list of stocks. But I think a separate subject and a very interesting subject which you raised was we have an agricultural sector which clearly needs to generate productivity growth, right? Because there are very few jobs in manufacturing or in the cities for the vast majority of people who live in the villages. Rural India has to give some employment, some sustenance to these people. Right. As the population in rural India grows, you need productivity growth in agriculture to come through, right? What's happened in our country historically is because that productivity growth hasn't come through, our politicians have tried to put some floor on rural India's standard of living by things like loan waivers and REG and so on. So they can carry on doing that, which in turn gives you some sense of why you shouldn't invest in PSU banks. But if leaving aside political support and political funding and largesse, right, if rural India is to find some economic sustenance, then these sorts of crop protection plays or specialty chemical plays, which help farmers boost the productivity of their fields, will become central to our existence. Right. And in specific, if the government were to reform fertilizer policy, and rather than doling out low-grade fertilizer in a subsidized manner, if the government were to say, look, we will give you the farmer the subsidy, you then figure out how you should spend it, you will see a real surge in protection in the crop protection stocks. Because if you were to move to a free market environment where the farmer can choose how to spend the money, I don't think he'll be buying low-grade fertilizer. He'll be making a more discerning call, right, on high quality either pesticides or insecticides or crop nutrients, and that's why I think this space is a very interesting space. Right. If rural India is to actually find its own economic sustenance rather than political dole-outs, I think the crop protection space has the potential to skyrocket. Yeah, thanks for inviting. Really appreciate it.
Absolutely. Thank you so much for your time, Saurabh. Always a pleasure talking to you. As for you guys, Saurabh's advice, it's time to get cautious on the markets. But we'll see you on yet another edition of Thank God It's Friday. Thank you for watching.